All right, we are going to go through Mass Mutual in this video. So Mass Mutual is a behemoth of a life insurance company, massive in terms of their size, and they are what I consider one of the four major mutual companies, which simply means they have always delivered strong cash values in terms of actual performance to policyholders when the policy is properly designed. So let's get into some information here. We're going to go through quite a bit, beginning with their 2021 dividend rate. So for 2020, their dividend rate was 6.2%. For 2021, it will be 6% flat, which is somewhat expected with all life insurance companies over the next several years, the next decade really. We're expecting dividends to flatline or somewhat go down just based off of the interest rate environment. Now, Mass Mutual, they have a 6% dividend rate. When it comes to their loan rate options, however, they have two options. A lot of people aren't aware of this. They have a variable loan rate option, which has a floor and current rate of 5%, has been there for a while now. And then they have a fixed rate of 6%. Here's the neat part. If we select the variable rate, our policy will be a non-direct recognition policy. However, if we select the fixed loan rate, then our policy will be a direct recognition contract. Now, there's one side note we need to be aware of with that fixed loan rate. It does function as a direct recognition contract, which we're going to go through exactly how that works here in a second. However, it does strip the policy of some flexibility as well, specifically with the riders that we can attach to the policy to bounce payments up and down. We're going to get more into the payment flexibility as we progress through the Mass Mutual material here. However, that is one important item to be aware of, that if we go with the fixed loan rate on a Mass Mutual policy, there will be certain riders that we cannot attach, which we've got full details in our membership program and agent training program. So let's get into it with their non-direct and direct recognition contract. So non-direct recognition is fairly simple. When I take a policy loan, the insurance company, in this case Mass Mutual, does not recognize the fact that I take out a loan, and they will pay me the same dividend rate on any money still in cash value and any funds I have loaned out. No lost opportunity cost. So for example, if I have a 6% dividend rate and I had $100,000 in cash value and I just let it sit and grow, I did not touch it, what would happen is I would obviously receive the 6% dividend on the full 100K. Now, if I elect to borrow out half of my cash value or half of my equity, the money remaining in cash value would receive the same 6% dividend rate. However, when I take a loan out, I should not have said however, I still receive the same 6% dividend as if I never touched it in the first place. Now, there is a cost to borrow. So with their non-direct recognition contract, I've got the 5% loan interest expense that does go to the insurance company. If I take out a $50,000 loan, that would be $2,500 over the course of one full year. However, I'm still receiving the 6% dividend on my full cash value as if I never touched it in the first place. Non-direct recognition, they do not recognize the fact that I take out a loan. Versus their direct recognition contract. A little bit different here than most companies. So Mass Mutual's direct recognition contract does what Guardian and Northwestern Mutual does with their direct recognition contracts, which is they actually raise the dividend rate on borrowed funds, whereas most direct recognition contracts and companies will lower the dividend rate on borrowed funds. So as we go through this, same example, if I have $100,000 in cash value and I elect to just let that money sit and grow, 6% dividend on the full $100,000. Now, if I take $50,000 out, what's going to happen here is the $50,000 still in cash value will receive the same 6% dividend because I never touched it. However, the $50,000 that I have loaned still receives a dividend. However, they actually raise the dividend to a rate greater than 6%. It's actually higher than 6.5% right now. They do not disclose what that exact rate is. However, in today's environment, they presently raise it. What I will add as a side note is if we go back several years to when MassMutual had a 7% and 7.1% dividend rate, they had actually lowered that dividend rate on direct recognition contracts to about a 5.5% dividend rate. So important to be aware of that. The main item to be aware, just to build more awareness here, is if I go with the direct recognition contract with MassMutual, they do have a bit more control over adjusting exactly how dividends are applied on my borrowed cash value. The main point, though, is I still receive a dividend on my full cash value. It's just a bit different with the money still in cash value compared to the amount that I have loaned out. Let's look at an example here to provide some visuals. So let's take a look at their non-direct recognition contract first. So we've got an example, 35-year-old male, paying in $50,000 for 5 years. Cash value right off the bat, about $44,000. Break-even point, year 5, compared to the loan example. Now you will find for the first 5 years, these examples are consistent because it is the exact same policy. The only difference is in one example, we took out a policy loan. So when we take that $200,000 loan out, the first question I would have if I'm you, if I'm the consumer, if we flip positions, is what is the impact on that policy loan? Because I state with a non-direct recognition contract, they pay me the same dividend on any money in cash value and the outstanding loan. They keep on paying a dividend. Why on earth would an insurance company do that? Well, 2 ways they do that. 1, there is a cost to borrow. So we've got the loan interest here. Direct recognition, 5%. Money goes to the insurance company. Okay, so here's the loan interest expense that goes to the company. The other way they do it, the other way they continue to pay dividends on my entire balance, is that they collateralize the death benefit. You'll see a dollar for dollar reduction in terms of the death benefit here. Remember, the insurance company's first and foremost obligation is to do what? Pay out life insurance claims. So if I die with a loan outstanding, the insurance company is on the hook for that much money less, right? Not 2.2 million anymore, it's only 2 million. Now, let's look at the impact here as time passes. So if we tally up those payments, I borrowed out $200,000, I paid back much more than $200,000. That was interest that went to the insurance company. If I stop there, I've paid interest on my own money, would make no sense. However, where it does make sense is, remember, they continue to pay me interest on that leveraged money as if I never touched it in the first place. A lot like real estate, right? If I've got a property that continues to appreciate, I might take a line of credit or mortgage out against it, and the interest goes to the lender. However, if the market value continues to appreciate over time, that's the advantage to leveraging real estate. Exact same thing with a policy, only I have guarantees that it will continue to go up. So, loan is paid back here in year 21. Cash value is $541,000. Compared to this example, when I just let it sit and grow, cash value is $541,000. No lost opportunity cost. My money just kept on moving forward. Here in bold, you see the dividend columns. No adjustment all the way through. Again, non-direct recognition. They do not recognize the fact that I take out a policy loan. Let's take a look at a direct recognition contract. Here's where it gets fun, depending on one's definition of fun. So, we briefly mentioned this. With a direct recognition policy, we do have to alter the design a little bit because we cannot use certain riders if we go with that fixed loan interest rate. The point to mentioning that is you will see slightly different cash values. 43.5 right off the bat, break even still year 5, but I'm at 252 instead of 253, a little bit less, and a dividend starting immediately. Now, same thing, funding for 5 years, same thing over here. Cash value, break-even point, all that good stuff. Here's the difference. So remember, MassMutual's direct recognition contract raises the dividend on borrowed funds when I take out a loan. The $200,000 loan comes out. Death benefit drops. Cash value is the equity or gauge that determines how much I can borrow. What happens here? On the dividend column, year 5, 48.79, over here, 48.79. On the loan example, when I take that 200K loan out, look at that. The dividend jumps by about $2,000. I'm at $6,800 now. As opposed to the growth example, I'm at $51.24. And if you'd like the details on this, as far as how to model these illustrations and the detailed illustrations, seeing all the nitty-gritty data directly from the company, we do have that available on our membership program and our agent training program. So time passes here. We begin to pay it back, $20,000 per year. Let's see the impact. Remember, that loan interest is going to the insurance company. And we have a 6% loan interest expense on this example, not a 5% expense like the non-direct recognition policy. But here's what we want to touch on. When it is paid back, cash value is $591,000. Compared to the example, when I just let it sit and grow, cash value is $562, almost $563. So about a $33,000 difference. Now keep in mind, we have a 6% cost to borrow here, so we're paying more interest, but at the same time, with MassMutual's direct recognition treatment right now and increasing that dividend on borrowed funds, that's why we see a greater cash value when we loan and repay compared to the example when we just let it sit and grow. So if we are considering a MassMutual policy and we're considering borrowing frequently, good option to be aware of. Doesn't mean that one option is the way to go versus the other, but good to be aware of them. This way I can see everything up front. Let's continue on to the next piece. So MassMutual, as a company, has a number of whole life insurance products. They technically have 8 core whole life insurance products. They actually have more if we want to consider their long-term care products and their survivorship products, but they have 8 whole life insurance products that are widely available and most people recognize. Their Legacy 100, high yearly cash value, 10 pay, 12 pay, 15 pay, 20 pay, L65. There's one more as well. When you look at their long-term care products, one of them is a blended whole life insurance product. But when we actually design the product, so with any whole life insurance product, we talk about this all the time on the policy design, right? Where can our money go? The premium or the PUA component. So we've got our base premium, and then often we will recommend attaching the LISR component. LISR stands for Life Insurance Supplement Rider. That is a combination of a 1-year term, a decreasing term rider, and a paid-up additions rider. The reason why we'll often recommend this is this does make MassMutual, which is typically a very inflexible company when it comes to adjusting payments if we need to or want to. If that rider is attached, all of a sudden we open up the flexibility to bounce payments up and down and not have to go through any medical underwriting at all. That rider does have to be set up properly so it doesn't burn out too early or too late, but you can do a lot of good with it if it's set up properly. Their PUA limitation is 10x. It's technically 9x. So what I mean when I say that, we talk about this frequently, is if I have a premium of $10,000, I have to have a term rider attached to do this as well. But when adding money into PUAs, I can add another $90,000 for a grand total of $100,000. So Mass Mutual as a company, and this is consistent with all of their whole life products, wherever I set my base premium, the total payment cannot exceed 10x that dollar figure. You can often illustrate higher. However, you will also get a warning message, if you're an agent, you know this, that this illustration exceeds 10x the base premium and will not be approved for sale. The one exception to that, when they will allow you to exceed those payments, is when it comes to catch-up contributions. So that has to do with the MEC limitations. If I have the ability to pay in $100,000 per year, let's say I pay in $50,000 year one, so I could have paid in $100,000, but I didn't. That means next year, with the MEC rollover laws, I have the ability to pay a total of $150,000. They will allow that. We've done that several times, and that can be an extended period of time with a catch-up payment as well, which is a nice advantage to be aware of, especially if we're in this for the flexibility and perhaps we have a lump sum or something like that coming in the future. All right, so PUA riders, they have a lot of them and a lot of different ways we can set this up. So primary PUA components, you have their LISR, life insurance supplement rider, which we just touched on. This is a combination of money that is directed towards PUAs and a decreasing term rider. This provides a lot of flexibility. Then they have AILR, which stands for Additional Life Insurance Rider. This is another name for Mass Mutual's pure PUA rider. We're dumping money into PUAs, accelerating the cash value growth. It also purchases us more whole life insurance death benefit as well. The LISR does too, but that's kind of masked by the term decrease. When it comes to their AILR component, 3 types of AILR they have: scheduled, unscheduled, and planned AILR. There's a lot of material on this because of the amount of time to go through this in thorough detail. We've got that in our membership program. If you're a member, we've got a thorough overview on those different riders and examples of how they work. But when it comes to PUA flexibility, what I will state is a combination of LISR and one or sometimes all 3 of these is critical to make the policy as flexible as possible. We always talk about wanting to have the ability to hit my target, right? So if I want the ability to put in $50,000 per year, but I don't want to get a bill for $50,000 per year, you can do this with a Mass Mutual policy. You can literally commit to a minimal amount. Perhaps it falls between $5,000 and $6,000 with the base premium and any term riders, and then have the ability to go up to $50K per year, which we're going to get into more detail on. But those are their different PUA riders. Let's continue on here with a little bit more information. Preferred design. So we kind of touched on this. If the goal is to optimize cash value and flexibility. Whether I need that flexibility or not doesn't hurt to have it in the event life happens. Being able to bounce payments up and down without the need to go through medical underwriting is advantageous, to say the least. For example, if we go back to the last sample we were on with the different riders, if we just have AILR attached, let's say I just want to throw money into AILR and I don't have that LISR component attached, Mass Mutual will often require that I go through medical underwriting, depending on the amount I pay in, before they accept my money. The reason why is anytime I add funds into AILR, it does naturally purchase me more death benefit, more life insurance. The company views that as a liability. Hey, Steve, why are you throwing this money in? Like, did you just find out that you're going to die tomorrow or something like that? We want to check your health before we accept the payments. So that's where the design is critical. Now, how we make a policy flexible, it does require a combination of LISR and AILR. Technically, you don't need AILR, but it makes it much more flexible, especially with what you can do with the MEC testing. Here's an important piece. 1 time per year payment. And the amount and time period is adjustable. So in the 1 time per year payment, Mass Mutual is not a company that allows us to throw money in at random into PUAs. They kind of opened that up January 2020 through their planned additional life insurance rider. It does have some flexibility. However, if we want to use a MassMutual policy in the most optimal manner, in my opinion, one time per year payments are the way to go. So what that means, something like this. Let's say year one, you paid in $30K. Year two, things were slower. You paid in $10K. Year three, you go up to $50K, assuming we design the policy not to mech. Years 4, 5, and 6, you pay in $20K. And then year 7, you want to make a catch-up payment and you pay in $80K. You can do that kind of stuff without medical underwriting if the policy is designed properly, and we can make one payment one time per year on our policy anniversary date. That's the key. So policy anniversary date, this is when our premium is due. It doesn't have to be on the exact day. Mass will give you a 60-day window, which consists of 30 days prior to your anniversary date through 30 days after. So you do have that window to make the adjustment and then make the actual payment, which can be annual or it can be on a different frequency. So for example, if I were to pay in $12,000 for the year, I could make a one-time annual payment, or I could break it up over 12 monthly payments of $1,000. If I pay monthly though, or any other frequency than annually, they do hit me with a fee, which is good to be aware of. But really with Mass, the preferred design and amount and way to structure the policy is to have a one-time per year payment, and then I can make the adjustment once per year on the anniversary date. Amount and time period adjustable. In fact, let's touch on this real quick. We're going to look at another example here, because this is valuable information. Is when we start a life insurance policy, if I have a desire to pay into it for 30 years, but life happens and I can only fund it for 5 years, will that mess things up? What if it's the flip side? What if I start a policy with the desire to fund it for 5 years, and then I learn more about the product, I fall in love with it, I see that I make a payment, I get a lot more back relative to what I pay in, hey, this is great. Can I continue to pay into the policy beyond year 5, or do I have to start all over with a new policy, potentially go through underwriting, go through the initial expenses again, or can I just keep feeding the beast, that existing policy? You can continue to enhance the existing policy. And this is a huge advantage MassMutual has, in my opinion, if things are set up properly. So here's a policy on a 40-year-old male. Exact same policy. Option 1, he funds for 5 years. Option 2 is 10 years, but look at the difference by year 5. Is there any difference here? No. Values are identical. And the reason why is because it is the same policy. The difference is in the 10-year example, he decided, you know what? I want to pay in another $20,000. And he does so through year 10. Same thing over here with 20 years and then 30 years. Exact same policy. Look at the year 5 values, all identical. And by the way, he can also adjust the amount. So we see $20,000 per year. One example going for 30 years. Does that mean he's going to be billed and forced to pay in that $20K every single year? No, he can adjust that amount as well. So we made it very flexible in that sense. This way he's not committed to a bill and has to pay that same amount in every month or every year. So that is a nice advantage, in my opinion, where we do not need to choose, per se, upfront how long that I want to pay into it. Because if life happens and I need to pivot, I want to be able to make those pivots. Let's continue on. Flexibility. So flexibility, what I mean when I say here is really call it user flexibility. When you've got a policy, how convenient are they to use as an insurance company, their online portal, make payments, take out loans, all that good stuff, because that's important, especially if I want to be able to use the policy as time passes. So Mass Mutual, in my opinion again, is most convenient for an individual paying the base premium and PUAs at the same time, where we talked about that one time per year payment adjustment, meaning the base premium and any PUAs, plop them all in together, because if I want to add PUAs at random, I'm either told no, or you must go through medical underwriting in order to make that payment. Kind of a pain and inconvenience. To make payments, I've got my online portal, which is the most convenient, or I can send in a check or pay via phone. When it comes to policy loans, same thing, where I've got my online portal, or you can work directly with your agent. If you work with our office, any of our agents, you've likely worked with our client relations department that primarily handles loans and other items. Basically, this makes sure that everything goes smooth, because sometimes I'll request a loan through the online portal, I'll ask for it to be sent direct deposit, and they'll mail a check or something like that. So it's just a smoother process. Point being, I can go to my online portal or directly through my agent. Adjustments. So for example, if I want to make a payment adjustment, if I paid in $10,000 last year and this year's coming up, I got a bonus, I want to pay in $30,000, best way to adjust that payment upwards is often through the agent. Mass Mutual does have a portal that allows you to make additional payments. However, they've improved that. They've come a long way, but we've still seen an inconvenience over on that side, if that makes sense. We've seen inconveniences occur to consumers. So typically, when one wants to adjust the payment, they reach out to us or reach out to your agent, let them know, here's how much I want to pay this year, and the agent can make all of the adjustments on the back end, and then the online portal is updated, where we can then make our payment into our policy. Annual adjustments, that's that one time per year payment adjustment on the anniversary date. And then, here's the most important piece, or one of the most important pieces. If we're considering mass, they are best suited for a level funding and one time per year payment adjustment. Meaning, if my goal is to pay in $100,000 for the next 15 years, that's $1.5 million, and I'm just shifting the funds in, and I'm fairly confident, hey, I don't need the flexibility to throw funds in at random, I'll have the payment once per year, Mass Mutual accommodates that type of client very nicely. Next piece. No PUA limit other than 10x the base premium. This is a huge advantage, and they do kind of gear their company, in my opinion, their company as working with the higher end individual. For example, when you look at their BOLI product, their bank-owned life insurance product, that is one of the strongest BOLI products in the industry. Has been for a while. They're number one. New York Life often falls number two. We actually put a BOLI in force earlier this year. Point being, they are catering to very, very high-end clientele, banks making large deposits. When you look at their individual products, it's almost the same thing. And what I mean when I say that, so when you see this limitation here, no limit other than 10x the base premium, is if someone wants to pay in $1 million per year, they can literally do the exact same thing someone wants to do that's paying in $10,000 per year. Have a premium of 10%, that would be $100,000, and then have the ability to throw PUAs in up to 90%. They have a term rider as well, but another $900K. Now, why that's an advantage for them is you will see other companies have PUA limits that may be 10x. For example, Guardian or Lafayette Life allow individuals to pour PUAs in 10x the base premium. Lafayette does not have a multiplier, but they both have a high-end cap, Mass and Lafayette, of $500,000. I'm sorry, I said Mass. Guardian and Lafayette Life both have a high-end cap of $500,000 in PUA payments per year. So why that's important is if someone wants to put $1 million per year consistently into a product with some carriers that have a $500K cap, you're going to run into some limitations there. whereas these guys do not have that. So you can really beef up a policy. Again, depends on my situation. We like showing all companies, this way we can see different options and such, but good to be aware of that. And then this we touched on as well. The funding can be adjusted after starting a policy. So just like that example we looked at, my plan is to fund for 5 years. Things go really well. I want to keep feeding this policy up until I'm age 70 at $20,000 per year. You can do that kind of stuff. And I do not need to declare it from the get-go, which is really nice. A lot of insurance companies, when we design the product, we have to have a sense of how long we want to pay into it. If we're in a position where you say, hey, I just don't know, like I want to fund for 5 years, but I might end up going much longer, you can, in fact, do that stuff with a MassMutual product, which is a nice advantage in my opinion. Last piece, cash value performance. So in the beginning of our MassMutual overview, we talked about MassMutual being a behemoth of a life insurance company and one of the 4 major mutual carriers. So why I always use the words big four major mutuals, or consider any company a major mutual carrier, is not their company size, not their financial ratings or anything like that, while those are important. The main thing that I emphasize here is actual performance on cash value and death benefit. Internal rate of return, meaning how do they illustrate, which MassMutual illustrates well, but then how do they actually deliver? That's the important piece. So we've got several policies from MassMutual that were issued in 1980, 1990, 2000, 2010, ones we put in force between 2013 and 2014, and we've seen that the performance has been consistent with them when policies are designed properly. We see the cash value IRR typically fell between 4 to 6%. Now with that said, I've stated in several videos, I'd set expectations a bit more conservative than that right now with the very low dividend rate environment. However, this is what we've seen, and even policies we put in force 2013 to 14, they're not at that 4% because they're 7 years old or so, but we see them performing on par. They're doing what we want them to do. Strong internal rates of return, policyholders are satisfied. With all of that said, the design is very important because I've seen personally, MassMutual policies that have been in force for 17 to 18 years that barely hit 1%. They were just traditional life insurance policies, low premiums, nothing extra added. So the design is very important there with any life insurance company. And a great way to see that is look at the guarantees. But with all that said, MassMutual, solid company. If we're comfortable with 1 time per year payments, great option. Historical performance is there. You've got the non-direct and direct recognition option, which is great. Can't go wrong with them. The only area they would lack, in my opinion, would be a little bit on the flexibility, but we use them quite a bit in addition to other carriers, again, because we've got that proof of performance. As always, I hope this helps. Reach out with any questions, and we'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.